So I think it's one of the more interesting things to track right now. So historically, the debt ceiling has only been used as a political tool pretty much since the aftermath of the global financial crisis. And historically, it's been used by Republican Congress against Democratic presidents. We've not really seen the reverse, although the sample size isn't very big. This is interesting because you might see a Republican versus Republican debt ceiling dispute. I think for that reason, it's less likely to be protracted than some of the inter-party disputes of the past. But until they get sorted out, it's certainly a variable to watch. One of the near-term implications, and it's somewhat counterintuitive, is that when debt ceilings are reached, for the months that follow, it tends to be pretty good for liquidity in the system. And that's because as they kind of reach their debt ceiling, they can't issue more debt. And so one of the actions that the Treasury can do is they can start with spending their existing cash balance that they have with the Fed. And that's generally about $800 billion in the current time period. And so basically that's spending money into the economy that they're not extracting from the economy. It goes back into the bank system, it goes back into bank reserves and throughout that financial system. And so you can have a multi-month period where if the debt ceiling is strangling net new issuance, it's good for liquidity until they get that solved. And then when they want to go refill that cash balance, that's when you get the negative liquidity effects. Longer term, I view probably less implications than average for the debt ceiling. Because they're still constrained by spending bills. So the debt ceiling is mainly about whether they're going to pay past obligations. It's not really about, it doesn't give the president more options to just unilaterally spend on things. It's just basically like a mechanical thing. If you kind of go back in the history, Congress used to basically do every minutia of Treasury issuance. They would kind of approve individual issuances and things like that. But eventually that became too unwieldy, basically during and after World War I. And so they said, okay, we're going to let the Treasury handle the details like duration, what kind of treasuries to issue, all the micromanaging stuff, and just you can't go over this limit. And so that's the system that they operate under. But it still requires Congress to actually pass spending bills in order for new spending to take effect.
With US debt soaring past 120% of GDP, the nation faces a fiscal crisis, unlike any since World War II. But unlike the post-war boom, today's structural entitlements, like Social Security and Medicare, are bleeding faster than they're funded, creating what Lyn Alden calls a slow-motion fiscal train wreck. Treasury cash balances, once an $800 billion liquidity buffer, are running dry, leaving a dangerous dependence on monetized fiscal deficits. Bonds, once a cornerstone of retirement security, have underperformed stocks, gold, and real estate over the last 5 years. So how does this end?
I think probably there's a difference between the two. I mean, I think Greenland has maybe more moving parts there than Canada. I think Canada's a non-starter, whereas remarks around Panama or Greenland are potentially more relevant. I wouldn't really take any of them at face value, but they're certainly worth watching. Greenland's relevant because they have a lot of strategic minerals, it's estimated, and of course they have a very important position in the Arctic. And so that one is potentially interesting. But overall, I think that there is more variance with this presidential term than the average presidential term. And so even compared to his first term. So, for most of the presidents in modern history have been fairly establishment. His first term was somewhat counter-establishment, but it was still largely within establishment bounds. This one, he's surrounded, he's kind of formed his administration out of a collection of non-establishment types, which differs from much of his prior term. And he's making kind of bolder claims this time around tariffs and things like that. So I do think there's a wider than normal gap of outcomes here. And I think that the first 6 months, the first year, are really worth watching because that's when they have the Republican majority in Congress. They probably want to do stuff before it gets to election season, like midterm election season. And so 2025 is really the year where some of these big things could hit. I think the tariffs in general, I mean, that's one of the biggest wild cards. I think in general they're purposely overstating it as a negotiating position, but it really remains to be seen how that's going to turn out, and it's hard to model because it comes down to a fairly few people's ability to make decisions. So I think that there's a lot of variance in the next 6-12 months or so. I think this is like the most sustained fiscal issue the United States has kind of faced in modern history. And the way that I generally characterize it, and we actually just released a research report on this. I collaborated with Sam Callahan on it. Our major takeaway is basically that this is far longer lasting and harder to fix than many of the optimists think, and yet it's not the near term crisis that some of the more like concerned people would think. I think basically that this is a longer term issue that's going to take a while, and the impacts are already hitting. They've really been hitting all throughout, the whole COVID era, and even probably the year before it. 2019 was kind of the year that I started really paying attention to it. We started to see some of the early results of it. And so basically, there's a couple different levers here. So the only time the U.S. was in this much debt to GDP in the past was World War II. That was they had a very strong manufacturing base. They had a much younger population, and so a lot of it was debt getting out of the Great Depression and then debt associated with the war. This one's different because this is mostly related to structural entitlements, things like Social Security, Medicare, a slowing population growth, and so those things became more top heavy. And some of their kind of Ponzi elements are kind of coming to fruition, that they're spending out more than they're taking in, because those programs are kind of based on the idea that every generation is going to be bigger than the prior one. So you're always going to have a lot of workers paying for every retiree or beneficiary, but that's getting less so over time. In addition to like a worsening health crisis, which of course expands medical bills as people age with chronic issues, and so that's kind of a structural thing. In addition, there's been 4 decades now of rising debt to GDP. So it bottomed in the late 70s, early 80s, started rising again. But that was combined with falling interest rates for 40 years. And so when you double your debt to GDP, but then you cut interest rates in half, that interest expense is still maintainable. But what happened recently is we bounced off zero in terms of interest rates, and we did a lot of fiscal stimulus, monetized fiscal stimulus associated with the pandemic and the lockdowns and the aftermath. And so that combination basically created a more inflationary impulse. And now that interest rates are going kind of, chopping sideways now, they're not really kind of going structurally down anymore, that interest expense actually starts to matter. It's one of the biggest areas of the budget. And one of the elements of fiscal dominance is that when you get a very high stock of debt, when you're well over, say, 100% debt to GDP, interest rates aren't really as effective of an inflation-fighting tool as they are in lower debt environments. So, for example, in the Paul Volcker area, most of the money creation back then was from bank lending. So bank lending was a much bigger contribution to the growth of broad money supply than monetized fiscal deficits. And so when he dramatically raised interest rates, it slowed down that borrowing, slowed down money supply growth, and among other things, like making sure oil kept flowing. That was a powerful inflation fighting set of things to do. The problem is that right now bank lending is not very significant. Even the combination of bank lending and corporate debt issuance is not very significant, and instead there's more money creation coming from monetized fiscal deficits. Even though temporarily they stopped monetizing them, they still step in whenever the treasury market has an issue. And so fiscal deficits exceed bank lending, and not just during a brief recession, but during an entire business cycle so far. And so the problem is that raising interest rates doesn't really slow down government spending. It doesn't force them to cut Medicare. It doesn't force them to cut Social Security. It doesn't force them to cut defense expenditures or aid. And then interest expense actually gets worse when they raise interest rates. And so it's a very different environment. It's an environment of fiscal dominance rather than monetary dominance, and that is generally a more intractable problem. It's something that it might not, like, I don't really expect the explosive inflation that we saw a couple of years ago unless we get similar events, major disruptions in energy or major broadening of war and things like that. But it does incline toward higher, stickier inflation, because when you're running 7% of debt, debt to GDP, and a lot of that is spendable money that circulates in the economy, that creates inflationary conditions. It also contributes potentially to wealth concentration, because it kind of comes down to whether or not you're on the right side of those deficits or not. So people that are either receiving direct transfer payments, or people that work for corporations that receive a lot of those payments. So you work in defense, you work in healthcare, and then that gets spent into the economy. But there are other people that are not on the right side of those deficits, and so they get most of the debasement without the direct payments, and so it becomes a very kind of politically challenging environment. And I think we've been seeing that play out for years. It could take longer than 5 years to play out. I think this could stretch into the 2030s. That's when some of the things really start to hit the fan, because you have, for example, the Social Security Trust is estimated to run out in the mid 2030s, which means without further legislation or other similar things, there would potentially be cuts to Social Security, which would be very politically problematic, because that's a big voter base. And so there is runway that can kind of go for a while before it becomes very acute. Kind of that 5 year mark is really, it kind of starts to enter that phase, I think, even though, like I said, we're already feeling some of the effects now, some of the inflationary effects. Long term, I think we generally will see a broadening out of reserve currencies. So, and we're already seeing this, that more central banks are holding gold, for example. There's been very little net accumulation of treasuries over the past decade by foreign central banks. It's basically flat, while they have accumulated gold pretty heavily over that time period. So I think we'll see that trend continue. We could see around the margins Bitcoin enter the conversation as well. It's about the tenth of the market cap of gold, and it's more volatile, so it still has a ways to go. But around the margins, like El Salvador and potentially some others are holding it. So you kind of see a trend toward neutral reserve assets, a trend toward the U.S. having to kind of finance itself more and more. The solution is, I think that's the hard part, is that it's going to be longer term, because if they just try austerity, because the U.S. Tax system is so financialized, it's so attached to the rising asset prices, even austerity could fail to potentially reduce those deficits. It would actually take pretty major structural reform to meaningfully fix those deficits, and I think that's probably only reached at pretty tremendous pain points in the system, and I think there's still runway left for that. But generally speaking, when debt gets this high, default occurs. And default can take two major forms. One is a nominal default. You'll normally see that when a country is in trouble with liabilities that it cannot print. So it's got foreign currency obligations or gold-based obligations and things like that. They're more prone to nominally default. Whereas when the obligations are in a country's own currency, which is the case for the United States today, instead you tend to see defaulting through purchasing power, which is every creditor gets paid back the full number of monetary units, but those monetary units buy you fewer things, or at the very least they underperform other major financial asset classes. So we've seen bonds, for example, already start this process where they've underperformed stocks, they've underperformed gold, they've underperformed real estate, practically anything else you want to own besides bonds for the past 5 years. They're still a tradable asset, but until this is kind of resolved, they're not a very attractive long-term holding asset. So I think that it's a long-term solved by a combination of major currency debasement, which we've already seen, but I think we still have more ahead. And then, after significant currency debasement, they can make major reforms to some of these things. But I think it takes a lot of pain points to get there, and we'll see what kind of polarization we go through along the way. You could have major political crises. So I think this is not really like one big event. It's more like a decade-long series of dramas that are going to play out.